Dear friends, welcome to Weekly View on Markets. This week, market have been highly volatile and we have seen sharp cuts in Nifty, Bank Nifty, mid cap and small cap indices. There is nervousness in the market. So, to understand the psychology in the market, let us look at the charts first. Friends, this is the daily chart of Nifty. I have retained the trend lines which I had drawn in the previous week. Now we can see that market has been steadily trending downwards and Nifty has closed at crucial level of 17,100. It slipped below 17,000 during the week but slightly pulled back and closed at 17,100. So if we look at the overall trend of Nifty, the intermediate trend seems to be down as chart is doing lower tops and lower bottoms. So where is the next support level? If we look at the previous low done during September 2022, 16,800 and 16,900 levels looks like a good support level. Market may take support from these levels if there is further drop in Nifty level. And 17,200 is a major resistance for Nifty in the coming week. Now let us look at Nifty Mid Cap Index. Again, Nifty Mid Cap Index has closed around 30,092 and it dropped below 30,000 and pulled back. I had been maintaining that the range broadly for mid cap index is 30,000 and 31,000. I think this range is going to be maintained in the coming week as well. Let us look at Nifty small cap index. Small cap index has dropped below the crucial level of 9,200 and closed at 9,094. If small cap index drops 9,000 level, then there is going to be a panic reaction in the small cap index. So for the coming week, 9,000 remains as a crucial level for small cap index. I don't expect that 9,000 levels in the small cap index will be broken in the coming week. Even if there is a drop for a day or two, it is expected to pull back immediately from these support levels. And 9,200 to 9,300 is a resistance zone for the Nifty small cap index for the coming week. Let us look at Bank Nifty. Bank Nifty has dropped below the crucial support level of 40,000 and closed at 39,598. And due to the global crisis in several banks, Bank Nifty looks more weak in the coming week also. Any pullback action is being sold into and Bank Nifty drops suddenly. So the support level for Bank Nifty will be at around 39,000 levels. I expect Bank Nifty to hold around 39,000 levels in the coming week and 40,000 to 40,500 will be the resistance zone for the Bank Nifty. Now let us look at weekly performance of indices. Nifty has closed at 17,100 with a cut of 312 points for the week. Bank Nifty lost 887 points and closed with a loss of 2.19% for the week. Mid cap indices lost around 2%. Small cap indices also lost more than 2%. So nervousness in the market has increased. The panic in the market has increased, which has increased the volatility index to 14.76. Volatility index up by more than 10%. Now let us look at sectoral performance for the week. Most of the sectors ended in red. PSU banks lost about 4.5%. Auto index lost about 3.89%. Private banks lost more than 2.5%. IT index lost more than 2%. FMCG and all other sectors lost -1 to -2%. Healthcare and realty were only trading in green and gained marginally during the week. Otherwise, the overall sentiment and in the mood in the market was negative, and almost all the sectors lost during the week. Now, let us look at fundamentals and economic indicators of the market. The technical charts present a gloomy picture about the market, but when we talk about the economic indicators and fundamentals, they are quite encouraging. So, wholesale price inflation index, that is WPI inflation index for February has come at 3.85%, which was at 4.73 in the month of January. The wholesale inflation index has come down, and the wholesale inflation index was in double digits a year ago. From there, it has fallen to 3.85, which is a good indicator that wholesale inflation trend is definitely down. And similarly, CPI, that is Consumer Price Index inflation, is also trending down. So in India, we are not in the upcycle of the inflation. The inflation has been coming down. As both WPI and CPI inflation is trending down in India, RBI will have more headroom to maintain interest rates and have a accommodative monetary policy in the coming months. RBI forex reserves is at 560 billion US dollars. More or less, the forex reserves have been very stable. Crude prices have dropped sharply by more than $7 to $8 in last 1 week and closed at $72.47 per barrel February. So crude prices, drop in crude prices, energy prices, and also commodity prices are helping inflation to cool off in India. Forex rate is at 82.7 p, which is quite stable between 82 and 83 for past several weeks. Dollar index has dropped from a high of 114 to 103.5. This has resulted in a stable INR. Gold prices have gone up due to the crisis in several banks in US and Europe. Gold is considered as a safe haven investment. So there is a surge in demand for gold, and gold prices have gone above 58,000 and closed at 58,277 for 10 grams. Last week there was European Commercial Bank policy meeting. In that meeting, ECB has raised the interest rate by 50 basis points. While ECB has raised the interest rates by 50 basis points, Chinese central bank has infused liquidity by 25 basis points. That means the Chinese are trying to give boost to the economy by increasing the liquidity, while the whole world is hiking the interest rates and following a tight monetary policy. China, on the contrary, has infused more liquidity and following a soft monetary policy. Next US Fed meeting is scheduled from March 21st, that is in the next week, and everyone is awaiting the outcome of the Fed meeting as on one side they are fighting the inflation, they want to raise the interest rate, and on the other side there is liquidity crunch in the banks. There is asset liability mismatch in the banks due to the successive and fast and consistent rate hikes by US Fed. So this time it would be interesting to see what kind of policy the US Fed is going to come up. Are they going to raise the interest rates further? That will have a impact on the bond markets, and also the bond yields will go up, which will again put pressure on the banking system as the assets held in US bonds by the banks will be shrinking due to the higher bond yields. So the next US Fed meeting is awaited with a lot of expectations from the market. And RBI policy meeting will be there in the first week of April. So that also will be having an impact on Indian markets. It is interesting to see that while there is panic in the market, the DIIs and FIIs, they are the knowledgeable investors in the market, and they have been buyers in the month of March so far. That means they are using the fall in the market to invest. FIIs by 6,408 crores and DIIs by 16,162 crores so far in the month of March. There is still banking crisis going on. Every after 2 days we hear that some bank in US has gone into trouble. So Silicon Valley Bank, Signature Bank, and then Silvergate Financial, and later we have seen in Europe, Credit Suisse has also gone into trouble. What is the problem in these banks? The, the banks are not insolvent, but they have a liquidity crisis. There is a kind of asset and liability mismatch. They heavily invested in US bonds, US federal bonds. And as US Fed has raised interest rates, the bond yields have gone up and the bond rates have dropped. And these banks have to show their mark to market asset value in the US bonds. So they are showing huge losses on account of this. And when they have shown bigger losses on their profit loss account, which is hitting their balance sheet, the depositors wants to take out money from these banks, which has created a liquidity crisis. If banks sell those bonds in the market, they will incur more losses. Otherwise, they don't have liquidity to pay back to the depositors. Fed has announced that they will buy back these bonds held by the banks instead of them going and selling them in losses in the market. So this has given a lifeline to the banks. Many people are comparing the situation to 2008 crisis, but I feel that this time it is a liquidity or asset liability mismatch problem. It is not a solvency problem of the banks. And now already everyone is alert. The banks have become alert. Fed has become alert. The central banks have become alert. Will there be more such events in the coming weeks? I don't think so. So, due to the improvement in communication technology and many other things, the information communication and understanding of the problem is much quicker. So, I don't think that the problem will result into a crisis like in what happened in 2008. So things should improve from here. Credit Suisse also got into problem, but immediately the central bank of Switzerland has come into the rescue of the Credit Suisse, and they have given additional credit line to the bank. So their problem also should get resolved in the coming weeks. There is drop in Indian market due to the meltdown in global markets, and the sentiment is down in Indian market. If we analyze the macro and micro data in the Indian economy, the fundamentals of Indian economy looks good. So the market correction in India is basically due to the nervousness and the sentimental impact. So this kind of correction gives a excellent opportunity for investors to invest, and they can expect very good returns from these investments in next 2 to 3 years. Mutual fund investors also should continue their investments, and if they want to invest lump sum amount, they should invest in 2 or 3 parts in coming months. See, it is said that the seeds of bull market are sown during the bad phase of the market when there is nervousness and fear in the market. So I believe in this principle of buying when there is a crisis, which will result in very good returns when the market cycle turns and there is a upside in the market. This is all for this week. If you like my video, please subscribe to my channel, share with your friends, and give your comments. We will meet again next week. Thank you.